Unlocking Mutual Fund Success, a guide to analysis. Investing in mutual funds can seem like navigating a labyrinth. With countless options and complex terminology, it's easy to feel overwhelmed. But fear not. Analyzing mutual fund performance is crucial for making informed investment decisions. By understanding a few key metrics and employing simple analytical techniques, you can unlock the secrets to mutual fund success. Imagine a maze representing the world of mutual funds. Each path represents a different fund with the potential for growth and rewards. But choosing the right path is essential. Without proper analysis, you risk getting lost or worse, ending up further away from your financial goals. Let's embark on this journey together, equipping ourselves with the knowledge and tools to navigate the exciting world of mutual funds. Deciphering the code. Key metrics for mutual fund evaluation. To effectively analyze mutual fund performance, it's crucial to understand the language they speak, the key metrics that reveal their true nature. These metrics act as the building blocks of your analysis, providing insights into a fund's past performance, costs, and risk profile. One of the primary metrics to consider is a fund's returns over different periods. This includes examining its performance over the short term, medium term, and long term. By analyzing returns across various timeframes, you can gauge the fund's consistency and assess its ability to navigate different market conditions. Next, we have the expense ratio, a seemingly small number that can significantly impact your returns over time. Lastly, risk-adjusted returns provide a more comprehensive view of a fund's performance by considering the level of risk taken to achieve those returns. By understanding these key metrics, you'll be well equipped to delve deeper into your mutual fund analysis. Time travel in investing. Analyzing returns over different periods. Analyzing mutual fund returns is like embarking on a journey through time, allowing us to witness its performance across different market cycles and economic landscapes. Examining returns over various periods offers valuable insights into a fund's consistency, volatility, and long-term growth potential. Imagine a timeline representing a mutual fund's journey. The short term, typically 1 year, provides a glimpse into its recent performance. However, relying solely on short-term returns can be misleading, as they are often influenced by temporary market fluctuations. Moving further down the timeline, we encounter the medium term, spanning 3 to 5 years. This period offers a more balanced perspective, capturing the fund's ability to weather market volatility and generate consistent returns. Finally, we arrive at the long term, encompassing 5, 10 years, or even longer. By comparing a fund's returns across these different periods, we can assess its consistency and gain valuable insights into its long-term growth prospects. Understanding expense ratios and their impact. High returns are appealing, but consider the costs of investing in a mutual fund. The expense ratio, a small percentage, can significantly impact your returns over time. It's the fee for the fund manager's expertise and administrative costs. Even if two funds have similar returns, the one with a lower expense ratio delivers more money. Over time, even a 1% expense ratio can erode your returns. Section 5. Risk versus reward. Navigating the world of risk-adjusted returns. Understanding the relationship between risk and reward is paramount in the world of investing. While high returns are enticing, it's essential to consider the level of risk taken to achieve them. This is where risk-adjusted returns come into play, providing a more holistic view of a fund's performance. Think of risk-adjusted returns as a way to measure how effectively a fund manager is generating returns relative to the amount of risk they are taking. Two popular metrics used to assess risk-adjusted returns are the Sharpe ratio and the Traynor ratio. The Sharpe ratio measures the excess return generated by a fund per unit of total risk, represented by standard deviation. A higher Sharpe ratio indicates better risk-adjusted performance. The Traynor ratio measures the excess return generated by a fund per unit of systematic risk, represented by beta. By incorporating risk-adjusted returns into your analysis, you can make more informed decisions and choose funds that align with your risk tolerance. Section 6. A case study, comparing returns and benchmark performance. Let's put our knowledge into practice with a real-world example. Consider two hypothetical mutual funds, Fund A and Fund B, both belonging to the large-cap equity category. We'll compare their 5-year and 10-year returns to their benchmark, the Nifty 50 index. At first glance, Fund B seems like the clear winner, boasting a higher 5-year return of 15% compared to Fund A's 12%. However, when we expand our view to the 10-year horizon, a different picture emerges. Fund A demonstrates more consistent performance, delivering a 10% annualized return over 10 years, while Fund B's return drops to 8%. This suggests that both funds have generated alpha, which is the excess return achieved above the benchmark. Section 7. The significance of metrics, making informed investment decisions. We've explored various metrics used to analyze mutual fund performance, but their true significance lies in their ability to empower us to make informed investment decisions. By understanding these metrics and applying them to our analysis, we can separate the wheat from the chaff and choose funds that align with our financial goals, risk tolerance, and investment horizon. Think of these metrics as pieces of a puzzle. Each metric provides a unique perspective, and when combined, they paint a comprehensive picture of a mutual fund's performance, risks, and potential. By carefully analyzing these metrics and considering our investment objectives, we can make strategic decisions, allocate our capital wisely, and position ourselves for long-term financial success. Remember, knowledge is power, and in the world of investing, understanding these metrics is paramount to making sound investment decisions. Don't miss the opportunity to claim your 10 free financial calculators, empowering you to take control of your financial planning and decision-making. Section 8. Claim your reward. Rs 21,000 awaits engaged investors. We're excited to reward our engaged viewers with a special opportunity to enhance their financial journey. For a limited time, we're offering a reward of Rs 21,000 to viewers who actively participate and demonstrate their commitment to improving their financial literacy. To be eligible for this exclusive reward, simply follow these easy steps. 1. Watch this complete video, paying close attention to the valuable insights and actionable advice shared. 2. Like this video and subscribe to our channel to stay updated on our latest content and exclusive offers. 3. Share this video with your friends, family, and social networks, spreading the knowledge and helping others on their financial journey. By taking these simple steps, you'll not only deepen your understanding of mutual fund analysis, but also stand a chance to win this incredible reward. Unlock financial freedom. Your 10 free financial calculators. We're offering 10 free financial calculators to simplify your financial planning. These calculators cover net worth, retirement corpus, loan EMIs, and investment returns. To claim, take a screenshot of this video and share it with us on WhatsApp. Our team will verify and send you a download link. Claim your 10 free financial calculators today and unlock financial freedom. Section 10. Conclusion: empowering your investment journey. In conclusion, analyzing mutual fund performance is not a daunting task reserved for financial experts. By understanding key metrics such as returns over different periods, expense ratios, and risk-adjusted returns, you can make informed decisions that align with your financial goals and risk tolerance. Remember to compare fund returns to their benchmarks and consider factors like investment strategies and portfolio holdings. The reward of Rs 21,000 awaits those who engage with this valuable information and take steps to enhance their financial literacy. As you embark on your investment journey, remember that knowledge is your most valuable asset. By continuously learning, analyzing, and adapting your strategies, you can navigate the exciting world of mutual funds and pave the way for a brighter financial future.